Have you ever had that moment? You're looking at your company's cash book, then you glance at the bank statement, and your heart just sinks. The numbers don't match up. It feels like a real mystery, doesn't it? Well, don't you worry, because today we're going to put on our detective hats and solve this financial puzzle, once and for all. So, every good investigation needs a solid plan, right? First, we'll set the scene and look at the mystery itself. Then we'll compare the two sets of records, yours and the bank's. After that, it's time to hunt down our main culprits, timing differences and simple errors. Finally, we'll learn exactly how to solve the case and, most importantly, why this whole process is so crucial. Let's dive in. All right, let's start by setting the scene for our investigation. I think we've all been there. You ask yourself that one dreaded question: where on earth did the money go? You feel like you've tracked everything perfectly, but the balance in your books just doesn't line up with what the bank is telling you. It's super frustrating, I get it, but I promise there's almost always a perfectly logical explanation. And here's the good news. This kind of thing is actually pretty normal in business. It doesn't mean your money has vanished into thin air. It just means we have a puzzle on our hands, and the first step to solving any puzzle is knowing where to find the clues. To find those clues, we need to understand our two main sources of information: your company's records and the bank's records. You can think of them as two different witness accounts of the very same financial story. Now, this is probably the biggest clue of all, and it's all about perspective. In your cash book, when you get money, you debit it, right? It's an asset. But for the bank, that same deposit is a liability. It's money they owe you, so they credit your account. It's the complete opposite for withdrawals. What you call a credit, they call it debit. It's like a mirror image. Understanding this is absolutely key to cracking this case. Okay, now that we get the two different perspectives, let's meet our first and most common culprit: timing. Seriously, this guy is behind most bank balance mysteries. So, what's the timing difference? Well, it's simply when you and the bank record the exact same transaction, just on different days. You might write down a payment today, but it might take a few days for it to actually go through the banking system. That little time lag is what creates a temporary and totally normal difference. And here are the classic examples you'll see all the time. Say you issue a check to someone. You immediately mark it in your cash book so your balance goes down. But what if that person waits a week to deposit it? For that whole week, your books and the bank's won't match. The same goes for checks you deposit, direct payments from customers, or even bank charges that you don't know about until you see the statement. Each one creates a temporary gap. Now, while timing is the usual suspect, sometimes our mystery has an unexpected twist. Our second culprit is something we can all relate to, unfortunately. Just plain old human error. Look, it happens to the best of us. Maybe someone on your team just forgot to record a transaction. Or maybe they typed in 970 instead of 790. It's easy to do. And believe it or not, sometimes the bank makes a mistake too. It's rare, but it happens. These errors are less common for sure, but they're critical clues you have to watch out for. Okay, so we've got our clues. We know about timing differences, and we're on the lookout for errors. So how do we actually put it all together and solve this thing? We use a special tool, our secret weapon, called the Bank Reconciliation Statement. Think of the Bank Reconciliation Statement, or BRS for short, as your detective's notebook. It's not an official accounting document. It's more like your working paper. It's where you systematically list out all those differences we just talked about. The goal is simple: to prove that both your balance and the bank's balance are correct, once you account for everything that's in between. So, how does this notebook actually work? It's really just a simple process of adding and subtracting. You start with the balance from one side, let's say your cash book. Then you add all the things that have hit the bank's records but not yours yet in a positive way. Then you subtract all the things that are bringing the balance down. You keep adjusting until, voila, your starting number magically turns into the balance on the bank's passbook. Let's solve a case together. We start with our cash book balance of 50,000 rupees. Now, let's find our clues. We issued checks worth 6,000 that haven't been cashed, and the bank collected 8,000 in dividends for us. We add those. On the other side, we deposited a 6,000 rupee check that hasn't cleared yet, and the bank hit us with 400 in charges. We subtract those. So, we take our 50,000, add 14,000, and subtract 6,400. And what do we get? 57,600. It matches the passbook balance perfectly. Case closed. But what happens if you're in overdraft?
An overdraft is just a negative balance. You simply spent a bit more than you had. The great thing is, the process is exactly the same. The only thing that changes is that your starting point is negative. And remember that mirror image? In an overdraft, your cash book shows a credit balance, while the bank passbook shows a debit balance.
Let's quickly solve an overdraft case. We start with an overdraft of $8,000, which is a negative, so it goes in the less column. Now, a check we issued for $800 that hasn't been presented actually makes our overdraft less from the bank's point of view, so that goes in the add column. But a check we deposited that hasn't cleared, plus some bank charges, they make our overdraft bigger, so they go in the less column too. We do the math, and our starting $8,000 overdraft adjusts perfectly to the bank's overdraft of $9,360. See, the logic holds up.
So we've cracked the case. We know how to find the clues and use our BRS to solve the mystery. But let's take a step back and ask the big question. Why does any of this even matter? Why is this such a fundamental skill? Because reconciliation isn't just an accounting exercise. It's about knowing the real amount of cash you actually have available. It's your number one defense against costly mistakes, or even worse, fraud. It keeps your records clean and accurate, which gives you total control over your cash flow. Ultimately, it's a vital tool for the financial health of any business. So there you have it. You've just learned how to turn financial confusion into financial clarity. You're not just an accountant anymore. You're a financial detective. You have the skills to find the facts and get to the truth. So my question to you is, what mystery are you going to solve next?